Hi there, it's Maggie Williams again, and today I'm talking about the business model canvas for implementing business and products course, and the subject of today's video is costs. So you know, one of my mottos is show me the money, and in that sense costs are really important, obviously. From a business point of view, costs are really important also because in the end the profit that you make, the whole point of your business in the end is revenue minus costs. Okay, that's the most simple version. There'll be, things like taxes, etc. They are not your cost, but cost that goes out to the government, etc. But in the end, your question is about how you're going to make money, how you're going to earn it, how you get the revenue, and then the cost is what is the money that you need to invest for that. And then one of the important questions in terms of optimizing your business model canvas is then again the question what maximizes revenue and reduces costs while keeping your value proposition intact. Now, as you can see, the costs are what underpins the key partners, key resources, and key activities. Those are the things that generate costs, and then the revenues come from the other half of the canvas. So there's different types of costs. One of the important things to look at is the difference between fixed costs and variable costs, especially if you're making a product. Then there will be some fixed costs involved. Just the basic cost, for example, if you're injecting molding, you need to make a mold. That is a fixed amount of money that you have to invest to get that mold, and then per product generated, you have the costs of the material and the operational costs of the people working there, electricity, etc. So there's the fixed element of the cost, and then there's the variable element of the cost. Typical fixed costs are salaries, rent, machines, because you have to buy them or pay them anyway. Typical variable costs are production materials, distribution costs, and salaries that are outsourced. So if you need more, you just get more people in from the job agency, etc. So it is really important to give costs if they are proportional or not. Now, if on the exam, if I ask what are to put some costs into fixed or variable, then give your arguments why. If you put it in the wrong category but have a reason why, then you might get the right answer still. How can you get cost advantages? An important way to get cost advantages is economies of scale. If you can do bulk buying or mass production, then as in general, as we say, if it's larger volumes, the price will go down. And then sometimes it can also, for example, help to buy together with others. So this economies of scale can add value by lower price, but also by being more generally available, other things. That is in terms of scale. Then there's economies of scope that are not so direct product related often, but business related, and those are in terms of marketing and distribution. So a typical example of economy of scope is the fact that all Nike products benefit from the money that goes into promoting the Nike brand. And if you have a smaller company with a smaller range of products, you cannot get to the same brand level as a bigger company, especially if you look at other things such as fast-moving consumer goods. There you often are looking for both economies of scope in terms of advertising into the brand and economies of scale in terms of production and distribution to the supermarkets, etc. Costs can also be very strictly related to management decisions. If you are working in a larger company, you will always have to propose a business case where you project the cost and the revenues of your project. And in there is often a very, you have to clearly divide between CAPEX, capital expenditure, and operational expenditure, OPEX. And there's definitely a difference, and it's not just academical or for the accountants, between whether you your costs are in investments or long-term, and in terms of accounting, these are assets that go on the balance sheet of a company, or that they are costs that are simply used up. So also if you're starting up your business, and if, for example, you're going into the market and you're looking for an investor, if you're asking for 100,000 euros of investment, and in your business plan that is all for the salaries, etc., to get the company started, then at the end of that year, that 100,000 euros will be gone. But if 50,000 is projected for the salaries of the people, and 50,000 for buying production facilities, then at the end of the year, those production facilities are there. So if the business fails, at least they can be sold off, and there still is money in there. So that is why these type of differences in costs, and knowing about, being able to separate them and separately explain them, can be important as part of building up your business case, of showing the money. Now, costs in relation to the value proposition, because in the end, the business model canvas is always centered around the value proposition. What are you, how are you delivering value to your customer? And it could be that that is very much cost driven. If you have an all-you-can-eat restaurant, or something where the value proposition is focused on being cheap for the consumer, then as a company or as a service developer giving that product, you have to, your thing is to bring the cost down. And for your competition, they are also trying to bring the cost down. So that is what calls a race to the bottom, because all people operating in that market will be trying to lower their costs, and in that sense give the best value proposition to their customers. And that can be a tricky business, because there is a race to the bottom, has its lower limits. At some point you cannot go lower in price without giving in on quality or legal issues, or workers' rights issues, etc. The other end of the scale is a completely value-driven business, where it doesn't matter how you get that value out to your customer, as long as it is the highest quality. That is when you're looking at luxury services, where money for the customer is not that much the issue. And then of course you cannot go too low on your costs, because then you're not delivering the value that your customer expects. Now, in general, the playing field is between these extremes, but those are the kind of tensions in how your costs relate to your value proposition. Now, in general, there is space for diversification in the value proposition. So if you look at the Accor hotel group, they have all different types of hotels. The value proposition, the sense of luxury that they offer there is different, and then the cost associated with delivering that value proposition is different. And also the people working in the Sofitel will probably have a higher wage than the people working in the Ibis. And so there is a relation there between the costs and the level of the value proposition, but it's not just that there's one thing, but they see space for different value propositions, and so they have like a portfolio of service options in the market. So in the end, it always connects back to the value proposition. How are you going to deliver that to your customer? And then the costs that you make to deliver that value proposition to your customer. That's what it's about. That's it for today. Thanks for listening.